Good afternoon, everyone. This is the continuation of our discussion on gains and losses from sales or exchange of capital assets. So in this video, we have already discussed the part one, and we have already talked and identified those capital assets and how to treat capital gains and losses from sale and exchange of capital asset, which is not subject to capital gains tax. So in this discussion, we're going to uh, start with okay for a while. Okay, so we are so with this one. Okay, so we are through with our discussion on principal residence. So let's continue on installment method of reporting an income. Okay, so in for the view of the seller, so income from deferred payment sale may be reported under the installment method since it is allowed in the law that certain sales can be collected for more than one period. So in that case, seller may declare or may report its income based on the amount of collection each year. So who are sellers or taxpayers that can avail the what we call an installment method of reporting an income? So for those for those seller or taxpayer by one who is a dealer of personal property on a regular sales of inventory and installment. So guys, the asset being sold is an inventory, therefore it is ordinary asset. So if ever that the seller, like for example motorcycle, motor vehicles, so the seller uh, sold the inventory and it is collected within more than one taxable year. So that's why the BIR allows, or the law allows, for an installment method in reporting of income, which is the basis in the computation of income tax due for that particular taxpayer. Then second, by one who is not a dealer of property on a casual sale of property other than an inventory, provided that the initial payment should not exceed 25% of the selling price. Okay? 25% of the selling price. Then second, of course, the selling price should not exceed 1,000 pesos because less than 1,000 and below can be considered as immaterial in reporting income. So obviously, you will no longer need to extend the reporting of income up to the next period since the amount is just immaterial. Okay, so letter C, by one who sells or disposes of real property in installment if the installment payments do not exceed 25% of the selling price and the sale is not subject to capital gains tax. Take note, the sale is not subject to capital gains tax. Okay, so an installment sale may involve property with clean title or no mortgage on it. So, or property with mortgage on it and the mortgage is assumed by the buyer. So when we talk about clean title, guys, this refers to real property and the certificate of title, or what we call the TCT. On the back of the or on the face of the TCT, it is annotated by the Land Registration Authority, or what we call LRA, the amount of loan obtained by the owner of that property. So in short, the property is being used as collateral for a loan, and the loan is called mortgage. So for your information, there are two kinds of mortgage. One is real property mortgage, which is the collateral is a real property, and the other one is chattel mortgage. If the collateral is a personal property, like for example like for example motor vehicles, either four-wheeled or two-wheeled. So those are considered as chattel mortgage. Okay, so let's proceed. Formula on installment method of reporting an income. So first, we have to determine the contract price. Okay, so that would be the selling price. So take note, guys, we are on the point of view of the seller. So you have to consider the selling price. Then if there are mortgage which is sold or attached to the property being sold, so and the mortgage is assumed by the buyer, so you should deduct the amount of mortgage assumed by the buyer. So you have to deduct it from the selling price. Then next is we have to add the excess of mortgage over the cost of sales. Cost over the cost of the seller. So like for example, if the mortgage is amounting to 1 million, then the cost of the product being sold is only 800,000. So in short, mas dako pa ang loan niya or ang utang niya compared sa cost sang aton nga seller. So in short, the difference will be considered as a gain. Obviously, that is considered as a gain. So that's why the excess should be added to the selling price. Okay? Then we can now arrive at the contract price, which we are going to use in the computation of the prorated amount of income to be recognized on an installment basis. Okay? So next, after determining the contract price, we have to determine the income to be reported or to be recognized each year for tax purposes. Okay? So first, we have to compute the gross profit rate. Actually, that is not, in accounting, the term gross profit rate, the formula is gross profit divided by selling price. But for tax purposes, the gross profit rate used in this method is gross profit divided by the uh, earlier computed contract price. Okay? Then multiply it to the amount or to the payment received by the seller every year, each year. And take note, the excess of mortgage over cost should be included and should be considered as a form of payment on the first year. Okay? On the first year on which the transaction happens. Okay? On which the transaction happens. So that would be the formula for the installment method of reporting an income. Okay, so next, let's provide some illustrative problem in order to apply those discussed a while ago. So Zenas had the following data on land held as an ordinary asset. Okay, so given information are the selling price for the transaction, which is for the taxable year 2021, the selling price would be 1 million. The cost of the uh, asset sold is 600,000. So obviously the gross profit would be 400,000. You don't need a calculator for that. Next, another given information, the schedule for payments for 2021 would be the down payment in 2018, that's 100,000. Another payment in 2019, that's 100,000. Payment in 2020, so 200,000. Then payment in 2021, another 200,000. So the question is, how much is the income tax to be reported each year by the seller? Okay? So using the installment method, first we have to identify the contract price in our case. So there is no mortgage assumed as provided by the problem. There's no mortgage assumed. So obviously, the selling price would be equivalent to the contract price. Sorry, the contract price would be equal or equivalent to the selling price since there is no mortgage assumed by the buyer. Okay, next, let's compute the gross profit rate. So gross profit rate divided by, sorry, the gross profit of 400,000 divided by the contract price, which is earlier computed, 1 million, that gives us a rate of 40%. Okay, so to answer the question, how much is the income to report each year? So we have provided 4 columns, each every year of collection. So on the first year of collection, what the seller receive is only the down payment of 100,000. So 100,000 multiplied by the rate, which is the prorated rate, the rate that we're going to use in our proration. So the income tax to be reported by the seller for taxable year 2018 would be 40,000. Then for 2019, the amount received is 100,000. So 100,000 times 40%, so it will give us an income to be reported of 40,000. For 2020, we have received 20,000, 200,000, multiply it by the rate. So we have 80,000 amount of income to be reported in our income tax return as if we are the seller. So for 2021, another 200,000 was received on an installment method. Multiply it by the 40% rate computed earlier. So we have an 80,000 income to be reported on the taxable year 2021. So that would be the answer in an installment method. So let's discuss another illustration in relation to installment method in the recognition of income. Okay, so another problem. Zenas had the following data on land held as an ordinary asset sold. Okay, so given information are we have selling price 1 million, cost 600,000, then gross profit obviously that's 400. Then another information provided is there is a mortgage assumed by the buyer. So the amount of mortgage is 200,000. Okay? So amo ni ang do unique compared sa earlier lang naton naging illustrate yung compute na problem. Next, on 2021, there is a down payment plus an installment payment kano. All in all, that's 200,000. Then on 2019, the seller also received 200 as well as in 2020 and 2021. So the same question, how much is the income to be reported each year? So first, we have to identify the contract price. So using the formula discussed earlier, you have to identify the selling price. So in our case, that's given 1 million. Then we have to deduct the mortgage assumed by the buyer. So that's 200,000. And compare, if ever, that the mortgage assumed by the buyer is more than the cost of uh, the asset sold, so there is an excess. Simply looking at the illustration or the given information, the mortgage assumed by the buyer is less than the cost. So that's why there is no excess. Okay, so your contract price is only consist of the selling price less the mortgage assumed. So that is 800,000. Okay, so let's compute the rate that we're going to use. That's gross profit divided by the contract price. Gross profit, simply by looking at the given information, that's 400,000. Then using the computed contract price, divide, and it will give us a rate of 50%. Next step is to identify the collections received by the seller every year from the date of sale up to the uh, up to when the buyer is scheduled to pay its dues. Okay, so for contract price, for the first year on the year of sale, we have down payment 100 and the installment payment of 100. So the total collection as given is 200,000. So 200,000 multiplied by the rate computed 50%. So that gives us 100,000 income to be reported on taxable year 2018. So follow the formula, follow the pattern, guys. So the amount collected each year is 200, 200, and 200 multiplied by the gross profit rate of 50%. So it will give us an income to be reported for the year 2019 up to 2021 in the amount of 100,000 annually. Okay, so that's case number 2. Okay, next is case number 3. Zenas has had the following data on land held as an ordinary asset. So given information, we have your selling price, your cost of 500,000, and of course, we have a gross profit of 500. So the schedule of payments that the seller were going to receive first on the year of sale, a mortgage of 600,000, which is assumed by the buyer. Then a down payment in 2019 in the amount of 130,000. Then an installment payment also in December 2019, that's 20,000. Then payment for 2020, 240. Then in 2021, that's 10,000. The same question, how much is the income tax to be reported on year 2018, 19, 20, and 21? So first, let's compute the contract price on this case. So we have your selling price. okay, less the mortgage assumed. Then, in this case, since the mortgage assumed is more than the cost of the property sold, so the excess should be added to the selling price and it will form part of the contract price which we're going to use later. Okay, so the contract price is 500. That's 1 million less 600 plus the excess of 100. Then the contract price would be, the contract price would be 500,000. Okay, so next, let's compute the rate. The rate would be gross profit divided by the computed contract price. So that's 500,000 gross profit divided by contract price of 500. So obviously, the rate would be 100%. So whatever amount collected every year should be declared as an income. Okay? Should be declared as an income each year. Okay? So for year 2019, we have received 130 as down payment and we have received an additional 20,000, and as discussed earlier, if the mortgage assumed is more than the cost, so the excess should be considered as a collection. So that's why the excess of 100 should be added together with the down payment and the installment payment. Okay, so the total collection on the year of sale is 250,000 multiplied by the computed rate of 100%, that gives us 250. All of the amount collected should be declared as an income on the year in which the asset is being sold. Okay, for year 2020, so the amount of 240 should be declared as an income. And for the year 2021, the amount of 10,000 collected should be declared as income, which is subject to tax for taxable year 2021. Okay, that's how you treat, how you declare income if the asset is sold on installment. Okay, so let's proceed. So this is a continuation in our discussion for installment method. But in this case, before the completion of payment, the buyer failed to comply or failed to pay the scheduled payment or the scheduled installment payment. So one of the remedy of the seller is to repossess the asset sold. Just like it is a common practice, and the basic example for this one is those seller or trader of motor vehicles like ng motorcycle, ng cars, like common manufacturers of Toyota, Mitsubishi, etc. So if ever that the buyer defaults is in default in paying the scheduled amortization, so the seller has the right to repossess the property. So it is well discussed in our accounting, but in tax purposes, how to treat or how to consider the income when the item or the property being sold is repossessed by the seller. Okay. So gain or loss on repossession property sold on installment. So when deferred payment sale with income reported by the seller under the installment method, the buyer defaults in payment and the seller repossess the property sold. A gain or loss to the seller will be recognized, measured by the difference between the fair market value of the property at the time of repossession. So when we say fair market value, that is the amount or the price of the repossessed property that can be sold to the market. So mga second-hand value. So ang value or ang market value sa mga second-hand ng mga repossessed ng mga motorcycle or motor vehicles as the case may be. Okay? And the basis to the seller of the receivable defaulted adjusted for expenses of repossession. So you have to compare the fair market value of the repossessed property versus the amount receivable or the amount that the seller is supposed to be collecting to the buyer if ever in case that the buyer is not in default. So the amount that the seller is expecting to collect from the buyer. So any difference would result into a gain or a loss. So let's illustrate, or let's use or apply that information in illustration in a sample problem. So we have Zena's sold property and reported income under installment. So given information are, we have selling price, the cost of the property sold, that's 100. Obviously, the profit is 100,000. Okay. So the scheduled payment should be, the date of sale is 2019. Okay, there are 50,000. Then the scheduled payment for 2020, another 150. But buyer failed to pay the scheduled payment in 2020. So after paying 50,000 on year 2019, the buyer failed to pay the amount of 150,000. So it is in default and the property was repossessed by the seller. Okay? Upon the repossession, or the date that the property is repossessed, the fair market value is 90,000. So this is the amount on which the second hand or the repossessed item can be sold to the second hand market or to the market. 90,000 kuno. Then because of processing and any other related expenses, the seller incurred an expense for repossession of 5,000. So the question is, the gain or loss on repossession is, how much the gain or loss on the repossession? First, let's identify the fair market value. Okay, that's 90 given. Then compared it to the uncollected receivable. So the amount that the seller should receive if the buyer is not in default. So that is 200,000 less the amount paid of 50. So that gives us 150. Okay? Then less unrealized profit. So how to compute for the unrealized profit? Of course, simply you have to identify the GPR, or the gross profit rate. So the gross profit rate is computed as 100,000 gross profit divided by the selling price of 200. So the GPR is 50%. So the amount of uncollected receivable, the composition of 150 is the cost and the supposed to be gross profit. But this amount cannot be collected anymore because the buyer is already in default. Remember? So that's why we have to recognize, or we have to remove the factor or the profit factor to the amount of 150. Kakason ta siya ang ginansya dire because hindi na siya ginansya. Okay? Kakason naton ang ginansya sa 250. Para makakas naton ang ginansya, kwaon tang iyang gross profit rate, which is 50%. So 150 multiply by 100,000 divide by 200,000 nga selling price. So ang unrealized profit is 75. 150 minus the unrealized profit of 75, and it will result into the cost, actual cost sang aton nga sang aton nga receivable. So that is 75,000. Okay? So the difference would obviously the book value supposed to be, the book value. Okay? Or the gain. But there is an expenses on the possession. According to the problem, according to the discussion earlier, the amount of expenses incurred for repossession should be deducted from the gain. Okay, that's why we have a deduction of 5,000. So the gain on repossession should be, the gain on repossession is in the amount of 10,000 pesos. Okay, so amo ni ang pwede pa mabaligya with regard sa pag-repossess ng property, kag amo ni ang cost sang property. Of course, the difference is gain. If ever that the computed cost on uncollected receivable is more than the fair market value, of course, the difference is a loss on repossession. Okay? So it will form part as your ordinary gain or loss. Okay? So in our case, gain on repossession is considered as an ordinary gain, and it will be included in the computation of income tax due, and it will form part of the taxpayers or of Zena's taxable income, subject to income tax table based on our discussion on previous topic. Okay, so that's how you treat, how you report income in case there is repossession. Right, so let's proceed with deferred payment method. Sa last topic that we're going to discuss for today. So deferred payment method of reporting income. It is like reporting an income on installment. So let's discuss. When the required when the requirement that the initial payment do not exceed 25% of the selling price in order that the installment method of reporting income may be available is not satisfied, remember the conditions that should be satisfied before you can avail or you can use the installment method of reporting an income is not met. So you have to use the deferred payment method of reporting an income. Okay? So in our previous discussion regarding installment method of reporting an income, if ever that the taxpayer does not comply with those circumstances or conditions provided by our law, so the taxpayer should use this method in reporting income. Okay? So the taxpayer may report income under the deferred payment method. Under this method, the taxpayer's obligation, example given, mortgage note, will be given its equivalent in cash. So the income will be reported over the years that collections are made. So let's discuss. Okay, by computing the illustrative problem on deferred payment method. So Zenas sold property and reported income as follows. So we have selling price 6 million, then we have cost 3,200,000. So the difference obviously is your gross profit. So payment made is cash payment on December 2019, that's 2 million. Then mortgage notes receivable schedule on December 31, 2020, December 31, 2021. Okay? So the mortgage has a fair market value of 80%, discount rate at its face value. Okay? So we will use the factor, or we will use like in our discussion in financial accounting, that we have to bring, or we have to recognize our investment at face value, or sorry, at present value, remember. So there is an assumption that there's an interest included in our mortgage receivable if we are using deferred method. Okay, let's compute. So in 2019, so the amount collected is 2 million. Okay? Then the fair market value of your mortgage, that is 2 million plus 2 million, that's 4 million. And using the discount rate of 80%, multiplied by 80%. So the fair market value of our mortgage is only 3,200,000. So the total collections made on 2019 is 5,200,000 less the cost, which is given 3,200,000. So the income to be reported on the year of sale is 2 million pesos. Okay? So for 2020, the amount cash collected is 20 million. We have to deduct the amount to be received on next, or on 2021, that's 2 million and it is discounted. So income previously reported, that's 2 million multiplied by 80%. So we have, sorry, we have already collected the amount of 2 million in the previous years, diba? So it was discounted at 80%. So obviously, our cash collection portion of that refers to the amount already collected on the previous years. That's 1,600,000. So the amount that we're going to report under deferred method is only 400,000. So for 2021, the amount collected is 200, and we have to deduct the income previously reported, which is 1,600, and the income uh, that we're going to declare and included in our taxable income for taxable year 2021 should only be 400,000. Okay? So that is how you report an income using deferred method. Okay. So that is the end of our discussion on gain or loss on sale or exchange of capital assets. So the last topic that we're going to discuss under this semester is year-end procedures. So kindly stay updated. See you next meeting. Until next time, God bless. Bye bye.